Hello everyone, Lewis Crompton here, and this is not financial advice. Have you ever wondered what one of the world's best, greatest, most loved investors for the past 50 years has to teach you about investing? Well, I'm going to share with you not one, but 10 bits of investment advice that I think are the best of what Warren Buffett, the man, the myth, the legend, has to say about longer term investing. When I talk about longer term investing, I am talking really about buy and hold positions in the stocks and shares markets. And if you want to learn about how you can do money better, how it is that you can make more of it in less time so that you can stress less, then like this video and subscribe to the channel. I am first and foremost a trader, which is a shorter term of investment, but I have also studied Warren Buffett. I've read his stuff, I've been researching him, his methods, and I apply them to my other styles of investing. So I'm talking about my stock holding portfolio. And if you want to start investing into stocks, if you want to start investing into shares in a way that takes very little time, then this is where you will need to understand some of the tips that I'm about to share with you. Let's get started then with number one. Invest in what you know and nothing more. Basically saying here that if you don't understand what a company is, the sector it's in, or how it operates, how it's run, you're probably better off not buying that stock. Taking it to another level though within this area, if you have experience within a particular field or have experience within a particular sector or a business, that should be the first area that you look to invest in. For example, I have got a background in retail. I used to work on the shop floor, then in head offices. And I understand that world a little bit better than others, so I'm in a better position to make investments into companies in the retail sector because I can look at it and understand what they're up to. And guess what? I don't. Why? Because for me, the retail sector is so up and so down, it is hard to predict anything. Many were hit incredibly hard during the COVID years. And during COVID, I looked for where the opportunities were in the markets, in the stock market, and what had been hit quite badly, but also what would recover over the long term. So it was a great time to buy if you knew how, and I did. And guess what? There's even better times coming up for purchasing and investing at a good price. Number two, never compromise on a business's quality. A high quality business is one that returns high yields on the money that it has borrowed. Not only that, they have good long-term prospects. Initially, Warren Buffett would kind of gamble, I suppose, with buying companies that he thought were priced quite low, even when they didn't have quite such a good long-term prospect. So why did he do that? Well, initially, he was anticipating that most companies would have some form of bad news, some form of good news, and that good news would cause the company to jump in value, cause their value to rise, at which point he could then sell that company at a higher price than he purchased it for. However, experience taught him that that didn't always work out very well. Most businesses move from solving one crisis to another crisis over and over and over, whereas higher quality companies don't have quite the same, I don't know what to call it, maybe panic rotation, and should have steadier, more predictable growth. Number three, plan to hold the stock you buy forever. Now, I agree with this. The right stock, especially if it is a high quality stock, is in a business with a good long-term future, meaning it's going to rise in value and be around for the long term. And it should be paying you a dividend as well. It's a little bit like a rental property that pays you rent. So dividends on stocks are like rents in properties. And if it is in a good area with good prospects, then why would you ever sell that property? Why would you ever sell that stock? As it increases in value, it also continues to pay you an income at the same time too. So it's a really, really good way of doubling your value growth. Number four, diversification can be dangerous, and that isn't to say that you shouldn't diversify at all, but don't go crazy. For example, Warren does not hold 100% of his portfolio in just one company. Look at me using his first name like we're best friends. He does own multiple stocks in multiple sectors. The problem comes when you're investing in so many companies that you just can't actually keep track of what is happening in each one, so you miss opportunities or you don't get out when you should. Okay investment opportunities may come around frequently, but great investment opportunities come around rarely. One of the quotes that I really like by Warren is, "When it rains gold, put out a bucket, not a thimble." Basically meaning get as much of it as you possibly can. Number 5, the news of the day generally means nothing. Warren sees most news as being just noise, and you have to realize that today's news is really just about entertainment. It's not really good quality information. We are so bombarded every single day, we ignore the majority of what we see, and most of it is not worthy. Does it really matter in the grand scheme of things if a major company, maybe like McDonald's or something like that, or Nike, with good long-term prospects, are missing a profit target by, I don't know, a couple of percent? It probably doesn't really matter. But when people panic, that can cause us to panic. It can cause the market to panic. And it is irrational behavior 99% of the time that causes the market to fluctuate in a big way. Number 6, investing isn't easy or quick, but it also isn't too complicated. Some of the smartest people I know are actually the worst investors. I'm not going to name you by name, guys, don't worry. Thankfully, I'm not that smart, so I do okay. What investing does require is for you to find an edge, something that works within the markets. You need to have a system or a strategy that you apply to the markets or to the stocks that you're looking to invest in. Businesses that you want to buy also need to come under that strategy. Now that is what I do with my trading students as well as my investing. That is what I teach my mentees, how to apply and how to test a selection of strict criteria that lead to those results. Number 7, know the difference between price and value. I could probably talk about this one for quite a long period of time. I see this behavioral pattern in people over and over again. Maybe I should do a separate video on this. I might do that. Now, when looking at stocks, there can be a big difference between the price they are currently asking and the value of the actual company, in either a good way or a bad way. So if you find a company that you believe to be high value, but currently at a low price, then it's probably a great time to buy it. You should go for it. If the reverse is the case, then it is a good time for you to stay away from purchasing that investment. Number 8, the best investments are usually boring. This style of investing that Warren uses will not make you rich overnight. And the more money that you have, the more you will make. That is why I wouldn't necessarily say to start your investment journey or your wealth building process and journey with this particular style of investing. Trading, yes, because it creates good cash flow. Business, yes, for the same reason, if you know what you're doing. Stocks is where you put your money to grow and be protected over the longer term. Similar view for me as to how I treat property now. The time it will take to find companies that are the rare gems that will be like Apple or be like Google in the early days may really come down to luck, the right position and the right network. We all wish we had bought Amazon 15 years ago, but that's a very easy statement to make with hindsight. Amazon may actually still be a really good buy based on where they plan to go in the future and what they are currently doing and who their leadership are and the goals that they have. Number 9, low cost index funds are sensible for most investors. I'm going to shout this louder for the people at the back. Low cost index trackers are a great idea. There are so many people out there trying to beat the market. The vast majority of them fail. Many people are better off putting their money into index trackers, which are low cost, and they let the magic of time make them incredibly wealthy. This is what I recommend to anyone who is wanting to invest in the stock market but doesn't know where to begin. For the patient, time is an incredible gift. For the impatient, it can be torture. So be patient with the growth of your money. It will happen, especially if you don't fiddle with it. That's the worst thing you can do. Number 10, only listen to the trustworthy about investing. Now, I'm not just talking about the guy you trust at the pub. Many people have an opinion about investing. That may be great for them. It may not be great for you. Do you trust them though? Beyond just trusting them as an individual, do you trust their track record? Are they investors themselves? Where has their knowledge come from? Do they have experience as opposed to just knowledge? Are they actually in a position to be giving you advice or tips, etc., etc.? I know of people who have lost a lot of money on potential investments that were recommendations they had received from friends of theirs. Thankfully, that has not happened to me personally, but for others, I know that is the case. So don't be that person, and don't be that friend giving the bad advice either. But if you do want to learn more about how it is that you can do money better, how you can make more of it in less time, then make sure that you like this video, you subscribe to the channel and turn on notifications. Share this video with someone who you think it's going to be really helpful for. My name is Lewis Crompton, and this is not financial advice.